So in the past, business owners have asked me what they should do to grow their business. Now, obviously, there isn't a blanket answer to answer that question because every business is different. And you really need to get deeper involved and see what's going on day to day to really give them an answer that would be most valuable to that particular business. But there are some strategies or principles that a business can use that would be shared across lots of businesses at a particular size. And that's what we're talking about in this video. So let's just make a blanket statement about this video. And what I'm about to share, there are basically a number of different levels in a business's life as it grows. So as it grows, you can think about it like you're climbing a ladder. And at each step on that ladder, it has specific things or specific actions and strategies it needs to take to climb to the next step on that ladder. Now, in this video, we're talking about the first 5 steps on that ladder because that's generally where 98% of businesses sit. Above that, and you're talking about the corporate world, and we're not all that interested in that end of the market anyway. So, what are the first 5 stages of a business? We'll look at this in an overall picture, and then we'll go deeper into it each level. So, at level 1, this is generally the self-employed person. It's a business that has one employee, and generally that's the owner. In terms of revenue, it might have up to about 100,000 in revenue. Normally, it goes up to that VAT threshold, and that's generally why the government set that VAT threshold at that level, because they know anyone employing staff will most likely be over that threshold. Stage 2 is generally between 2 to 5 employees, and normally up to about $250,000 in revenue. And by the way, some of these numbers might merge into the level above them or below them. This is just a general guide. You might have $500,000 in revenue, but still need to use one of the strategies at stage 2 for you to really move up to that next level. So as I go through each stage in more detail, have a think about whether that's a piece that you've already got or something that you've already done in your own business, even if you think you're at the level above. If you don't have a piece at one of the lower levels, it could mean your business might fall back to that level in the future because that's like the weakest link in the business. It's like the foundation. So stage 3 is between 5 to 20 staff and generally less than 2 million in revenue. This is the level where most small businesses grow up to and then don't go any further. And we'll get into the reasons behind that in a minute. Stage 4 is between 20 and 50 staff and typically less than 5 million in revenue. And then stage 5 is more more than 50 staff, generally up to 250 staff and up to about 25 million in revenue. Now there's only about 1.3% of businesses that actually are in that category. And there isn't really an upper limit on revenue or staff numbers in the stage 4 and stage 5 levels. At these stages, it's just really about what you want the business to be. But I've put these numbers in because that's where you find that the most businesses at these levels sit. So let's look at stage 1. So stage 1 is the self-employed person. So if you're at this stage and you want to grow the business, what are the strategies you can use to get to stage 2? The main thing to focus on at this stage is to team up with someone that already has a customer and then deliver to their customer. Now, this process starts with thinking about who your ideal customer is. And if you've already got a few customers, you'll probably already have an idea of who you like working with and which type of customer has the most potential for growth. So if you've got an idea of your ideal customer, then you need to identify who is already working for that type of customer that you could then partner up with. So a typical example of that, let's imagine you're an interior designer and you decide that your ideal customer is hotel owners that want to renovate their hotels. So you identify the type of companies already supplying to that type of customer, and they're construction companies and architects, let's say. So you partner up with both of these types of partner businesses to sell your interior design service through their business. And then next, you'll create a product offering that helps them target customers to solve the problem, but also delivered in a way that the partner company that you sell through will also make money by working with your business. And then third, you have to think about this customer as being a lifetime relationship. What most people do at this stage is they'll get this customer, but then they'll immediately be looking for the next one. And what happens, they just end up jumping from one to the next, and they never build that relationship that leads to repeat business. So they never end up growing. They think they're making progress, and maybe they win a bigger contract, but then the same happens again. And they always end up back where they started, because they've not built that foundation relationship where they can build on that repeat business. And sometimes that relationship might actually mean doing something for free. If you treat the customer like they're your best friend or a family member, they'll like your business much more than that corporate supplier that they phone up and it takes them 3 weeks to get back to them. But I found just doing the most simple things, like doing what you say you will, is actually what makes a difference. Something as simple as, if you say you'll turn up at 9 a.m. on Wednesday, you actually turn up at 9 a.m. on Wednesday. You have to make them believe that they are your priority in life. I'm not saying you have to put them above the needs of your kids, but just create the perception that that's what you're actually doing. And then finally, use a very basic level of systems to do what you need to do. If you need to create a quote for a customer, let's say, use the basic tools and systems that are already available in the market. Even better, use the free tools that are available. Don't go out spending money on these custom software packages that have 1,000 different features, but you only need one of them. I know a company that was a startup, and instead of focusing on finding customers, they spent 2 years creating an operating manual full of hundreds of these written procedures and flowcharts of how to deal with these imaginary situations. But the problem was, when the business actually started to get customers, nobody ever looked at that operating manual. And the staff, they could never find the document that they needed on the computer. They'd spend half an hour just looking through these template documents that had been created, trying to find the right one, because when this operating manual was created, instead of naming each document according to what it was, for example, a quote, instead, they gave it this long, complicated reference number, which made no sense to anyone. So instead of doing that, focus on getting one customer at a time and creating a customer that wants to work with you for life. It's at this stage you build up credibility in the market, and you start to create those case studies that you can show other people about the types of projects and customers that you've already been involved with. Now, you don't need to worry about creating case studies right now. That can come at either stage 2 or stage 3. Just focus on exceptional customer delivery. Now, at stage 2, you've got a few staff, but you're the one that's generally doing everything. So the main area of focus at this level is to put together a team that you can use for delivering what you deliver, project teams. And that means you might work with other small businesses that you can call on for a particular project to give you that extra capacity when you need it. For example, if you're a plumber, you might work with another plumber. And then when you get a larger contract, you agree to work together on it, and likewise, they do the same with you. Additional to that, you have to identify what products or services are in demand right now and create a product offering around that. You have to package it up. You might have multiple packaged offerings like that. So for that plumber example, one of your product offerings might be heating systems inside office buildings. And then second, grow your customer base through referrals. Now, this might mean, for example, you work through another company like a managing agent. You need that initial proof that you can deliver. And that's what you got from stage 1. And then you demonstrate that proof to these third parties or other referrals. And then third, work on delivering outstanding service. The goal is to keep those customers coming back, but also telling others as well. And then finally, create some basic systems for tracking things like customer flow and making things as simple as possible. For example, you don't want to invest in creating your own software program when you could buy an off-the-shelf product to keep keep track of things like timesheets and other things where you might otherwise spend a lot of your own time. You want to try and replace your unproductive time with external ways of doing it, such as basic apps or software, or using an external partner like a virtual assistant. At stage 3, this is up to around 2 million in revenue and up to about 20 staff. And obviously that number is going to vary because some businesses, for example, I know a cleaning company that employs about 200 staff and they've got less than 2 million in revenue. So every business is going to be different, but let's say 20 staff full time. And this is where most small businesses stop at this level. Most don't go above this to up to the next level up. And that's because the business owner is so busy running things, they don't have any time to do what they need to do if they want to get to that next level. And the key to this stage isn't about the business owner getting busier. It's about the business owner moving aside and replacing themselves in that day-to-day management of the business. They need to work more strategically. This is what they say about not working in the business, but working on the business. At this stage, the main focus to reach stage 4 is for them to build a full management team. And that means someone who's responsible for getting new customers, someone managing operations, and someone taking care of finances. At this level, the business owner is generally trying to do all of these things. But the key is to hand over that responsibility to someone that's more experienced than you are in each of those different areas. Now, additional to building a management team, you should also create a wide product mix so that your customer can get everything that they need from your business. And that might mean that you partner up with other companies that actually provide even more credibility to your own business. For example, there might be a company that provides a specialist service. So by partnering with them, so long as they have a good reputation, you can sell that service to your client, and then you earn what's called borrowed trust. You're borrowing the good reputation that partner has built up in the market. Second, look at how you convert new leads and inquiries into paying customers and try to streamline that process. For example, in one of our previous businesses, we had a long process where we had to tender for new contracts. And so we created a template of how to price certain projects so that we knew no matter who put together a tender, it would come out at the same price. If we hadn't done that, it would mean Jimmy might make a guess that the project would take 100 hours, but Sheila might think it would take 2,000 hours. So by creating that template, it removed that personal guesswork out of the process. It also meant that every tender was created and presented in the same way. Third is about quality control. How do you create predictable delivery? Again, in our own business, we had a process of firstly training staff to do things in a certain way. And then when a project was complete, we'd have a different member of staff go through and check the project was complete to a set standard. And we'd create a checklist so that they could do that. This means that if you've got a project in London and you've got a project in Australia, you know that both of these projects will be delivered in exactly the same way, and they'll both have the same outcome, regardless of who is actually working on them. And then finally, creating more formal systems and processes and training staff in those processes. One main system to focus on is financial tracking. So not only producing monthly financial accounts, but also tracking how profitable each customer and contract is as well. Because without this level of information, if you try and operate as a stage 4 company at the next level, and you don't have this tracking in place, this is where you could get involved in a much bigger contract that you end up losing money on, and then the whole business ends up going bankrupt because you didn't know what was happening day to day from that contract perspective. At stage 4, the main focus is to remove yourself from the business completely. That means, first of all, building a board and attracting someone that can lead the business without you being involved. This is where you move from being a manager to being a shareholder. Again, it's that strategic move up. Now, at the stage 3 level, You might have taken the business to the point where you only spend a few days a month working in the business. But even at this level, you're still needed for those few days. This stage, the objective is completely removing yourself as if you no longer exist. You're aiming to just attend a monthly meeting just to get an update on what's been happening. So at this stage of the business, your aim is to build partnerships. Your growth focus is more about selling through partners rather than selling through the business's own sales team. You might want to cross-sell your products with partnered clients and vice versa. And one strategy to do that more easily at this stage is to acquire or merge with a complementary business. As a third, making sure you have a customer-focused approach so that it doesn't matter whether the service is provided by your partner or by your business. The customer always receives the same level of care. And then finally, if you haven't done it already, creating systems to manage the business remotely with daily data and reporting to show you exactly what's going on in each part of the business, from how many sales you made today to how much money each of your customers owe. And then at stage 5, your main focus as a business owner is to attract resources, money, and talent whilst your team grows the business day to day. At stage 5, you'll probably have a number of stage 4 level businesses, locations, and investments all being run by their own management teams. So at stage 5, in order for that to happen, you've created a holding company structure with its own high-level team. They're overseeing each business or investment. You probably employ your own lawyer and accountant as part of that director level team at this stage. As part of your strategy at this stage, you'll want to have a 5-year product plan with the intention of having a full product range now and for the customer's needs 5 or 10 years into the future. And that could be where you go out and acquire a number of other companies so that you can create that full product offering. And second, you'll need to customize the experience for each stakeholder that interacts with your business. For example, up till now, you've only really had 1 or 2 areas of focus in the other levels in terms of your customers and your partners. Now you want to create a product offering, an experience that focuses on not only your customers, but also helping your partners, helping your investors, helping your staff, and helping the community that your business operates in. These become almost like individual businesses, each serving that group of people or businesses. And then third, you become a guardian of your community. That doesn't just mean the community you live or where your business operates. It means your whole industry. You become a spokesperson for your industry. You promote the people you believe that can shape your businesses, but also the industry overall. And that might mean shouting about someone in the industry that doesn't even work for your businesses yet. This is about investing in these communities and helping them develop without the intention of getting anything back. And finally, investing in and creating world-class systems that will help you to grow and develop each of your businesses. But the main focus at this stage is attracting a stream of external investor funding. If we look at stage 6, this would be about creating each of your stage 4 businesses into the standalone stage 5 businesses. It would be creating an ecosystem of large stage 5 level businesses. Now, there's a clear focus or clear strategy at each of these levels for what is most important to you as a business and that one thing that you're trying to increase: cash flow, profit, and asset value. And you can obviously track and measure each one of these, first with a cash flow statement, then to track profit, you've got the profit and loss statement, and thirdly, tracking the asset value is on the balance sheet. So if you're a stage 1, 2, or 3 business, your focus is on increasing cash flow. This is where most small businesses sit. So you'll be more inclined to reduce your profit margins if you can get paid faster. Another example of that is when you use factoring or invoice financing. You finance your invoice, but that means you sacrifice profit in the business because you have to pay for that finance cost. And so the normal process at this level is to ask for upfront payment, or maybe have really short payment terms with clients, maybe 7 days, or not really any more than 30 days. And you probably have a short-term focus thinking about this month, and that's really about it. At stage 4, this level business is more likely to sacrifice cash flow and asset value in favor of improving profit margins. So you might charge higher prices than at the earlier levels, but you can afford to give the clients extended payment terms because cash flow is less important at this stage. And then at stage 5, you're only interested in asset value of the business. So you're looking at the business purely as an investment, and you probably have a 3, 5, or 10-year plan with the idea of selling the business in that time or listing it on the stock exchange. But the focus is all about doing whatever you can to increase the value of that business. And one of those strategies is to increase your market share with the intention of owning as much of the market as you can. Now, here's the important part to bear in mind. If you know what your focus is or should be based on the level that you're at, you should also identify what your competitors' focus is, because you might be a stage 3 company competing against much bigger companies, and maybe they're at stage 5 and their focus is on owning the market. That means if they really want that client that you're bidding for, they can afford to deliver the contract at 0 profit, but also tell the client they can pay for it in 12 months' time. That would be a bit extreme, but in theory, that's what they could do. Whereas you might be able to do it for 0 profit, but you need to be paid as soon as possible. So it puts your business out of the running. Now, what that also means is, in times of recession, or even when a business loses a larger contract, these bigger companies can afford to keep those staff employed because they aren't bothered about what's happening now or in the next few months. Their focus is on building that capacity over time. So when the recession ends, they've already got the resources. But if you're that stage 3 business and you lose a contract, you're going to have to get rid of staff. Now, what this means is, when you identify who your competitors are and what level they're at, you might decide that it's actually better to be a supplier to them instead, at least until you grow to that next level, and then you can rethink it. Now, when it comes to clients, you ideally want to target clients that are either at the same level, or ideally they'll be the next level above your own business. Likewise, your suppliers will normally be either the same level or one level below your business. If you're at stage 3 or below and you're trying to raise investment, it's going to be almost impossible. This is because investors normally look for businesses that are one level below them. At stage 5, investors are either very small private equity type investors, or they might be small companies that look to invest in 2 or 3 businesses in that particular industry. I know of less than 5 private equity firms that operate at this level. Most are in stage 6 or stage 7. So let's look at a few examples that we've used in our own businesses at each level so you can get a better understanding. So at stage 1, 2, or 3, your focus is on increasing cash flow. So I just wanted to show you an example of the supply chain in the construction industry, so you can see how it relates and hopefully translate it to your own type of business. You can see that at stage 1 and 2, this is the subcontractor doing the work. Maybe it's a house being built, and the plumber is self-employed. Perhaps they've got a couple of staff working with them. But these are the most focused on cash flow. Without that cash every week, they don't buy food and they can't pay the mortgage. They're basically the next step up from an employee. At the stage 3 level, you've got the builder, and this company maybe has 10 or 12 people working for it. So it's still focused on cash flow, but it's managed to build up a bit of a reserve over time, and so they get paid either monthly or at fixed stages in the contract. And then at the stage 4 level, you've got the developer. Now, the developer is most interested in getting either maximum profit or maximum sale price, so they don't get paid until the end when the house is sold. So they might need to wait a year or 18 months to get paid. And if they're at the stage 5 level, they might have purchased that land 10 years earlier, Maybe they bought it when it was cheap during the recession, but they had to wait 7 years for the market to pick up again. So at this level, they're more interested in getting the maximum sales price, and they're willing to wait until the market cycle is right. Because at this stage 5 level, it's about increasing the value of that asset. And when we're talking about why would the stage 4 company want to be focused on profit, increasing profit, and it's because they need that additional profit to pay for that management team and all those extra systems and things. So that's why they would be focused on profit rather than cash flow. The next stage, stage 4, here's an example we used in our own business. It was a mechanical and electrical contractor. And you remember at this level, you most focused on increasing profit margins like we just talked about. And so what we did with one client, they wanted to replace the light fittings in their office building. So they asked us how much it would cost. Now, I don't remember the numbers, so I'll share the process we used as an example and of the strategy for this level. So let's say the cost to upgrade the lighting came to 50,000, and they said they didn't have the budget for it, and it would have to wait. That rather than losing the sale, we said, what if instead of paying for it in one go, instead we do the work now, but we do it as part of a maintenance contract? And rather than paying for it now, instead, we charged them a monthly fee for the maintenance contract. Now, what this meant was we spread the cost of the upgrade across 3 years. But by doing that, instead we charged them a maintenance fee of $2,500 a month. And this meant even after we paid for the financing cost, we ended up increasing our profit margins by over 30%. Now, at stage 5, you're interested in increasing the value of the balance sheet. So an example of this was again in our contracting business. So our intention at the time was to grow across the country, and to be able to do that, we would target a certain area, and in order to get some initial contracts and staff in that area, we'd underbid on a long-term contract, we'd underprice it. So for example, that might be bidding on new housing developments, or it might be a long-term council contract. But by winning that contract, it gave us demand in that area that we could build on, and then win other contracts in the area and attract more staff. And but those initial contracts, although we didn't make much money at them, or if anything, it would give us work to support a handful of staff for up to 12 months. But as an alternative strategy, we could have used at stage 5 level, could be to buy a business. Buying a business in each of these new areas, it would have achieved the same result of increasing our coverage area. But one thing to be cautious about, if you choose that strategy, is by doing that, we would have sacrificed profit and cash flow within that acquired business, because any profit would have gone to pay the debt on the business from us buying it. Now, one problem comes, let's say a recession happens, or maybe something happens to that business that you've bought, and it loses some of its best clients. You have to be able to support that business and keep it trading through your existing business. And this is why it's a strategy for stage 5 companies, because a stage 2 or stage 3 business wouldn't be able to finance both businesses. It just wouldn't have the cash flow there. Now, it's obviously important, whichever level you're at, to keep an eye on all 3 areas: cash flow, profit, and asset value, especially as the business gets bigger. And there's an example of one company that didn't do that and ended up going bankrupt. Now, you might have heard of a construction company called Rock. They were a national construction company based in Exeter, but they had offices all over the country. Now, as a stage 5 level business, their focus was on owning the market, and they had 2 main strategies to achieve that. The first is to go out and buy lots of local businesses. And then the second is they'd underbid on contracts just to try and win a large client in a particular area. In one example, they approached one of our long-term clients, and this particular project was a new hospital that was being built. And they offered to provide the contract at below their cost price if the client would give them other contracts in the area. Now, what happened was they was obviously following this same strategy across the country, maybe on hundreds of contracts. But then the 2009 recession hit, and they started to lose work. But the problem was they bought all of these companies, and they were financing the losses on all of these underbid contracts and those companies that they bought. And I guess they just couldn't afford to finance those debt repayments anymore. And in the end, they went bankrupt. And in the year leading up to that, they lost over 300 million on these loss-making contracts. See, they were using stage 5 strategies, but they were doing it too quickly without keeping an eye on the other two, on the cash flow and the profit areas. They had nothing to finance those losses or pay for those companies with when the economy started to slow down. If they'd got more of a foundation company, that could have financed those losses. But every business they had, it was basically following the same strategy of losing money. So we touched on the idea of if you wanted to raise investment, but you were at stage 2 or stage 3 level, and an investor just isn't interested at this level. Even if you look at new startup companies, those which raise money, it's because they've designed the business to operate at that stage 4 level. And this is the same for your own business. Even if your business is at stage 3 level right now, maybe you don't even want to grow it to that stage 4 or stage 5 level. You can design a brand new business at whatever level you want. This is what startups do, or the startups that raise money do. They design it by putting the pieces in place that are required at that level. So although it's only a startup, they'll have a full management team, and they'll have all of those other pieces from those levels below that level, because those are like the foundation for that stage 4 level. Now, if you've not seen my videos on joint ventures, I go much deeper into this process about how you could design such a business. So that's it for this video. Obviously, there's a lot of sub-strategies you can use at each stage to achieve those steps faster. If you've not seen my other videos, I've recorded over 400 videos talking about the various strategies you can use to grow your business, regardless of what stage you're at.